On July 29, 2026, the Federal Reserve announced a decision that seemed routine on the surface. But beneath the official press release lay a historic fracture. For the first time in nearly a decade, the committee is deeply divided. This live coverage from CNN highlights the immediate shock. While Chairman Kevin Warsh announced a rate hold, three policymakers openly broke ranks. It is the first time since September 2016 that we have seen three dissenters on a rate decision. The official decision was to hold the benchmark interest rate unchanged at a range of 3.5 to 3.75%. Yet, the consensus that held the Fed together for years has officially shattered. Wall Street reacted instantly to the internal division. The Dow Jones Industrial Average dropped approximately 2,489 points, a 1.4% decline, while the S&P 500 and Nasdaq slid 0.5 to 0.6%. Many retail investors assume a rate hold means stability. In reality, Chairman Warsh's vague inflation language has left the committee fractured, leaving crucial household mortgage and borrowing decisions completely up in the air. Three dissenting policymakers actively voted for a rate hike. This reveals a highly hawkish faction operating directly under a non-committal chairman, creating massive policy ambiguity. Chairman Warsh stated there is no tolerance for persistently elevated inflation, but he consistently refuses to provide clear rate roadmaps. This leaves the market guessing about the Fed's next move. With inflation still sitting stubbornly above the Federal Reserve's target of 2%, the path forward is highly uncertain. Retail investors are left vulnerable as the central bank refuses to commit to a direction. To survive this period of central bank division, we have to look past the public statements. The bond market is already pricing in a much more aggressive reality than what the official press release suggests. Analysts at BMO Capital Markets noted that these three dissent votes signal the committee is far more hawkish internally than their public language admits. The unified front is gone, replaced by internal friction. Because the chairman will not commit to a clear direction anytime soon, investors must prioritize cash liquidity. Locking in yields, now through fixed income hedges, can protect your capital before market chop emerges. To navigate this divided environment, focus on a few key actions. Lock in yields while they remain elevated, maintain cash liquidity for flexibility, and prepare for increased market volatility as policy diverges. Lock in fixed income hedges. Prioritize cash liquidity. Prepare for market volatility. The Federal Reserve is no longer acting as a unified body. When the committee splits, the market always feels the tremor. Navigating this landscape requires looking at votes, not just press releases. Not financial advice, for educational purposes only. Clarity will come as data forces direction. Hedge against uncertainty now. Subscribe and follow the Phantom Equity for the next rate path reveal once the committee converges or diverges further.